and we'll be live.
Got it. Hello, everybody. Hello, everybody. Thanks for joining in on a Sunday morning. Today, we're going to start with, or we're going to discuss return expectations from portfolio managers in rising markets. The theme is sort of broad-based. We just don't want to talk about our small cases, but we want to talk about markets in general, where they are heading, what are the external indicators that we are seeing, what is the behavior of the markets as a whole, and in such a scenario, what should be the return expectations of investors from different kinds of managed portfolios like mutual funds, PMS, as well as small case, and how historically, what is the historical returns of these managed portfolios being like. So let's sort of start with, what are the leading economic indicators that we've been seeing in the recent times and how they have been behaving. The first one is India Composite PMI. PMI is basically Purchasing Managers Index. So there are two kinds of PMI, the one on the services side, on the other on the manufacturing side. And a number above 50 indicates expansion or that purchasing managers are very positive about business growth. And a number below 50 indicates contraction, or that the purchasing managers are not so confident about business growth. So as you can see from the chart, Purchasing Managers Index, the historical average has been around 51, 52. And in recent times, especially since October 21 onwards, so there's been a continuous uptrend. And, it has reached, I think it has reached the highest level of 61 for May 2023. So that indicates that, future growth expectations from the Indian economy is quite high for purchasing managers across both services as well as the manufacturing companies. Next, we have the RBI Housing Price Index, which indicates the rise in prices of houses across top Indian cities. And you can see that since January 2023, there's been a continuous uptrend. And if you compare, March 2022 to March 2023 numbers, there's a fair bit of upside that has been recorded. Even outside of RBI Housing Price Index, I think if you look at commentaries from real estate companies as well as consultancies that track real estate companies, there's a fair bit of growth that has been witnessed both on the number of units that have been sold on the residential side, as well as the prices of these units. Those are the first two. Next, we have domestic auto sales. Obviously, passenger vehicles have been doing extremely well, 26.7% growth, and this has been one of the highest units sold since 2017-18 period. On the commercial vehicle side also, there's been 34.3% growth. Once again, the number tops what was the highest levels that was last seen in 2017-18. However, on the two-wheeler side, though there has been 17% growth, you can see that 2017-18 was one of the best years, and then we topped that with 2018-19 performance, and we are a fair distance away from that performance with 2022-23 numbers. 1.5 crore units sold during 2023 numbers compared to more than 2 crore being sold in 2018-19. So what this indicates is that, and even within the passenger car vehicles level, what we've been seeing is that the higher end models, which is SUVs and the likes, have been seeing a fair bit of traction, whereas the entry level models like Alto, WagonR, these kinds of models have not been seeing the same amount of traction. So what we feel is that this grassroots level demand is still sort of recovering. We have seen that with commentaries coming out of FMCG companies also over the last 2 quarters. There have been lots of green shoots that are visible. Rainfalls being normal is a good thing for this year as well. Consumer price inflation, as you can see, has been continuously trending down. So all these factors we feel will revive the two-wheeler sales as well as entry-level model sales, and that is going to be a fresh growth engine for domestic auto sales going forward during the 23-24 period. So this is as far as the leading economic indicators are concerned. So economic indicators are essentially those indicators which tells you which direction the economy is heading, and things like housing price index, inflation, auto sales, and these factors sort of are a harbinger of what is coming up for the economy. If the auto sales is constantly poor, then you can sort of understand that there has not been too much of growth sort of coming in, or inflation expectations are eating into purchasing of goods, whereas increase in purchasing managers index or auto sales, drop in consumer price inflation, increase in housing prices as well as units, all of these point to expected good economic growth. So these are the outside factors that affect the stock market. So as you can see, the recent stock market performance, especially since March 2023, there's been a fair amount of sort of gain that has happened. And if you try to compare that with what has happened over the last 1 year, you can see that most of the growth has come in the last 3 months. So Nifty 100 has been up 16.3%. But if you can see from June 2023 last year, there was a long flattish period, and it is only since March 2023 that this upside has come up, which is and the Nifty 100 is up 9.7%. Very similarly for Nifty 500 also, though over the last 1 year it is up 19.1%. Most of the growth has come in the last 3 months. Very similarly for Nifty mid cap and small cap 100 also, right? So this is as far as the recent stock market performance is concerned. Now, what are the factors within the stock market we feel is sort of also points to sort of like a long-term bull trend? One thing that sort of works is, one thing that sort of indicates an emergence of a long-term bull trend is every time the stock market hits a high, the high should be greater than the previous low, and the high also should be greater than the previous high. So the gray bars over there indicate the lows, and that is the lowest during a particular month, and the orange bar indicates the high during a particular month. And if you look at the gray bars, you can see that since March 2023, the lowest point in March 2023 was when Nifty 500 hit 14,844. Next in April, the lowest point it hit was 15,077, and then in May it was 15,759. And in June, it was 16,201. So every time the lowest point within a month has been constantly increasing. Very similarly, another point is that every month, the maximum level should be surpassed by the previous month's maximum level. And that also can be seen. In March, it was 14,953. In April, it was 15,200 and odd. May, 15,824. And in June, 16,277. And all of this is not just index levels that have been increasing, volumes have also been increasing. You can see that in April 23, that gray line at the top sort of starts increasing. And the annualized volatility of Nifty 500 has also started trending down since about February 2023. So a combination of higher lows, higher highs, increasing average volume, as well as dropping down of volatility, indicates that within the stock market also there is a fair amount of positivity, and it looks like the the markets are all set to go to a higher level from where it is already. One another factor that is also sort of driving growth is the FPI investment. The reason why I'm only talking about FPI investment and not from domestic perspective is the SIP numbers have been fairly stable for a long period of time, and retail Indian investors have been taking advantage of all the dips of the market, and they have been constantly investing in the markets. And it is the foreign portfolio investors who have been moving in and out of India for some time now. So which is why we will take a look at what their expectation is from the market. And you can see that calendar year 2022 was fairly bad, close to 120 crore rupees went out of the market. And on a year-to-date basis, that is since Jan 2023, close to 59,000 crores have come into the market. And you can see that most of that money has been pumped in since March 2023, when the market started raising up, or rather because this money has started coming in, the markets have also started trending up. So these are sort of like, a combination of external factors like housing prices, auto sales and stuff like that, as well as internal factors, higher highs, higher lows, drop in volatility, increase in volumes, increased FPI investment. All of these factors, if you look at it together, we feel that sort of like, gives us a view of where the market is heading. And we are confident that, we can expect a good performance going forward also. So one of the factors that sort of like, that has been bandied about a fair amount in the media and stuff like that is that market is at an all-time high. Should we be very careful? What is the direction of the market and stuff like that? So you can see that over the last 5 years, the Nifty has given only about 11.7% CAGR returns, right? That is on an average each year, the CAGR returns has been 11.7%. And over the last 3 years, the CAGR returns have been 23%. So between 2018 to 2020, the performance was fairly flattish. And it is since 2020 that it picked up. The market started picking up. But then once the Russia-Ukraine war started, you can see that between February 2022 and June 2023, the markets were fairly flattish. We are still at the same levels that we were in June 2022. And it is only since March 23 that we've started seeing this uptick in the prices. So in my opinion, we should not be unduly worried about markets being at an all-time high and stuff like that. Markets are going to be at an all-time high at any point in time. What is important is the valuations and the historical perspective. If the historical performance has been very flat, and if your valuations are still you have that valuation comfort, markets being at an all-time high should not cause a lot of worry when it comes to investing. So this chart obviously points out to the historical valuation of Nifty 500. I'm talking about Nifty 500 all through this presentation because it indicates the market. It has large cap, mid cap, as well as small cap stocks. So Nifty 500 has been around 26x. Trading PE for Nifty 500 has been around 26x over the last 10 years. And you can see that it is the current trading PE for Nifty 500 is still below the historical levels. So I think there is a fair amount of valuation comfort also as far as the market movement is concerned, right? Now, we've spent a fair amount of time talking about, external indicators, internal indicators, how FPI money has been coming in, valuations, market movements and stuff like that. So as far as the markets are concerned, I think that sort of settles the debate. Next, I want to sort of move out into different, what is the return of asset classes and why one should look to take some kind of exposure to equities. So what I have pulled up here is the average return of asset classes for various holding periods, right? So the different asset classes that we have here is equities, real estate, gold, PF and FT. All of these are fairly easily accessible to Indian retail investors. And what I have done is I have calculated the average returns across 5 year, 6 year, 7 year, 8, 9 year and 10-year period. The reason why we have multiple years, that is not just 1 5 year or 6 year or 7 year, is it might happen that if 2023 was a very good year, then the returns during 2023 will spike up, which means due to that particular effect, we might get an incorrect picture about how a certain asset class performs. We wanted to eliminate any such bias, and we wanted to make sure that during every single period that we are looking in, we wanted to get a picture of that. And this sort of this chart provides that picture. And you can see that the green chart, obviously, which is equities, I've taken Nifty 500 for that. The price performance of Nifty, just the price performance of Nifty 500 beats the performance of all other asset classes, whether it is real estate, gold, PF or FT. I've not even taken dividends into consideration. So I've just taken the price performance, and you can see that on an average, it's been close to 13.5 to 14% historically, which means on an average, investors have gotten 13.5 to 14% every year historically. And just by price performance, it has beaten all other asset classes. Next, we have real estate. The approximate performance has been 12 to 12.5, close to 13% also sometimes. And then we have gold and PF and FD, obviously, right? Now, there is another price chart that I want to pull up to show you how these asset classes have been performing over the long-term period. So this chart indicates what is the value of rupees 100 that if an investor had invested rupees 100 into any one of these asset classes, what is its current value, right? So the black line at the top indicates equities, which is a proxy for Nifty 500. So if one had invested rupees 100 back in 1996, that amount would have grown up to become 2,500 or a little more than 2,500 rupees. And you can see that large gap between what would have happened to an investor who put money in equities versus somebody who put money in real estate or gold or PF or FD. So these are the next best asset classes. So obviously real estate and gold have over the long term made the same amount of returns, would have generated the same amount of returns. And then we have PF and obviously FD. Now, one thing that a lot of times investors come in with, like, real estate is so good, I get to see the land that I have invested in, I know what is happening to it, and I can track its performance, and these kinds of things we keep saying. And we also keep listening to the same kind of justifications as far as gold as an asset class is concerned. Now, this chart should tell us what has actually happened to the historical performance of real estate as well as equity. Now, you can see that the brown line here is the line indicating real estate. We have taken the RBI housing price index to sort of calculate this particular line. That is the data that is feeding it. So you can see that historically between 96 to 97 till 2004, the line was fairly flattish. There was not too much of gains to be had by investing in real estate, right? Real estate was not a investment option, or it was not a good investment option back then. And then starting probably 2003, 2004, the line started trending up, and this 2003, 2004 till this 2013-14 period was very, very good. You can see that large jump from probably about sub 200 levels to about close to 1,000 levels, right? And then from there onwards, the line has sort of, it is not very flattish, but the growth has sort of tapered down. This extraordinary growth that we saw between 2003, 2004 till 2014-15, that extraordinary growth we have not seen in close to a decade. And you don't have to take my word for it. The RBI housing price index is available publicly. Anybody can pull up, anybody can check to see how the index has been performing over the last, since 96, 97 or onwards. You can study the performance for yourself, and you can see that between 2003, 2004 till 2014-15, almost every year the growth was in high double digits, right? It was close to 15%, 16%, 18%, and 20%. But since then, it has dropped down, and the average growth probably since 2017-18 has been not more than 5% each year, right? So that is a factor that one needs to consider before thinking about real estate as an investment option. Then the next asset class that we get a lot of queries around is gold, right? You can see that gold has performed exceptionally well starting 2021, and it has risen up a fair bit. But then please also note what has happened to the performance of gold between 2011-12 till 2018-19. So for almost 7 years, gold prices were very, very flat. This was because there was no external pressure on gold. Things like inflation, political uncertainty, wars, all of these things contribute to the exceptional performance of gold. Whenever there is high inflation, whenever there is a risky macroeconomic scenario because either due to wars or some other crisis, gold tends to perform very well. Because of the absence of that, gold price was very flattish. And then we saw a little bit of jump, and then it was flattish for once again almost 2 years between 1920 and 21-22. That is till the Russia-Ukraine war started. In spite of COVID and the likes, gold performance did not spike up. It is only once the Russia-Ukraine war started, the performance spiked up, right? So anybody who's invested in gold or is looking at gold as a long-term investment option should keep that in mind, that there are going to be large periods of flattish performance that you're going to witness with gold. Whereas with equities, you don't really have that problem. Now, there is a fair bit of up and down happening between 2004 to 2008 because of global financial crisis. Obviously, the markets dropped. And then we had one drop here again in 14-15 and 15-16 period due to a little bit of political uncertainty. And then there was COVID-related drop. And then here there is a, like right at the top, there is a little bit of, downward performance due to Russia-Ukraine war and stuff like that. So in spite of the volatility, what you can see that over the long term, equities has the potential to take your portfolio places which no other asset class offers you, right? So I hope that clarifies as to why invest in equities. Now, the next slide that I want you to look at is which sort of explains to you that volatility that I was talking about. whenever we are investing in equities, one has to understand that the market always tends to trend up in the long term, right? We saw that previously also. Now, in this chart, in the chart above, if you see, in 2009, Nifty level was at around 4,000, and today we are close to 16,000, right? Which means the market has trended up since then continuously, and it is almost like a line that I have plotted in the chart below, right? But at the same time, the calendar year returns have not been consistently positive, right? In 2010, it was around 14%, and then in 11, it was negative 27%, 32%, then 4%, 38%, flattish, negative 1% in 2015, 4% in 2016, and so on and so forth. So the market return tends to be like a wave that, that keeps going around the median returns. It is never a flattish, sort of like, a very linear performance. It tends to be a very wavy performance, and there is a lot of volatility and, human behavior that drives this performance. But one has to understand that, this year-on-year thing, in the short term, there is going to be a significant amount of volatility. There could be negative returns as well. But in the long term, the markets always tend to trend up, right? I hope that clarifies as far as market cycles are concerned. Now, next, when we are talking about market cycles, I just want to briefly touch upon our understanding or clarify our understanding of what is return and what is risk. Now, returns are fairly simple. When anybody is talking about stock market returns or returns on real estate or returns on gold or any other asset class, returns indicate the change in price of an asset, an investment, or a project over a period of time. So if somebody says, I made 30% returns in the stock market, it means over the last 1 year, it means that they had invested 100 rupees. For example, they had invested 100 rupees, and that 100 rupees turned into 130 rupees over a period of 1 year. That is returns. That is fairly straightforward. Now, slightly more philosophical concept is risk, right? Now, we tend to use, when we are talking about risk, when we are talking about returns in conjunction with risk and stuff like that, we tend to use volatility, we tend to use standard deviation and call that a risk. But philosophically, one has to understand risk slightly better, right? Risk means more things can happen than will happen, right? Now, nobody, I think, at the start of 2020 had anticipated that there would be a COVID pandemic and that everything across the world would be shut down, right? That was, so anybody standing in Jan 2020, for them, they had not foreseen that at all, that there will be a pandemic and things will get shut down, which fits into this definition of more things can happen than will happen, right? That possibility, now we know. We don't, so essentially risk says we don't know what's going to really happen, right? We walk every moment into the unknown. There is a range of outcomes, and we don't know where the actual outcome is going to fall within that range, right? So today we could talk about a range of outcomes for Nifty being Nifty for the market being like 10%, 15%, a flattish performance of 5% or 20% also, or an exceptional year of returning 40% returns also. So these are the range of outcomes, but no portfolio manager or no investor can for sure say this is what it is going to be, and that is risk. We can represent it using volatility or any other means, or that is totally fine. But at a philosophical level, that is what risk is. So I hope that clarifies. Now that we have understood risk, I want to sort of briefly touch upon what is the relationship between risk and return. Now, on the x-axis, we have plotted risk, and on the y-axis return. A lot of times investors think or look at it from a perspective of the higher the risk, the higher the return. That is not the case. The way it has to actually work is the higher the risk there is to a particular instrument or an asset class, investors should expect higher return from that particular asset class or instrument to compensate for the risk that they are taking. That is very important. So the graph should be interpreted as investments that seem riskier have to promise or have to appear to promise higher returns so that it is worthwhile for people to buy into such an asset class, right? So this is a very, very basic understanding of risk and return. And I hope, this is one of the most important takeaways from today's presentation for you. And I hope sort of like, everybody understands this. Next, we have this risk and expected return from different asset classes. A lot of times people tend to think of gold and real estate and all other investments, and they don't understand the risk associated with that, or they don't tend to associate risk with it because they feel that gold prices are always tend to go up, real estate prices always tend to go up, or somebody invested so much amount of money in real estate 20 years ago and that has turned into crores today and stuff like that. But if you look at it from a risk and a return angle, this is how the matrix for risk and return works. At the lowest point, we have liquid funds that have the least risk and they offer the least amount of return to you. And then you have bank FD, you have long-term gilt funds. Gilt funds are essentially government securities. Then you have high-grade corporate bonds or even gold funds, right? You have all of those things. Then you have large cap stocks, slightly riskier when compared to any other asset class, but then the expected return also tends to be higher. Then you have high yield corporate bonds, essentially junk bonds, which are issued by companies that are not financially very stable. Then you have mid and small cap stocks and real estate. Real estate tends to be one of the most riskiest asset classes, and the return expectation has to be equally high from this asset class. One should not look at it from a perspective of the returns tend to be high and so the risks are higher. It is the other way around. Because it is risk, the expected return should be very, very high to compensate for that additional risk that investors are taking. Then we have return expectations from, this is what I have pulled up here is the actual, returns from mutual funds. So there are a couple of different dots that you're seeing over there, or different colors. The blue color indicates large cap stocks, large cap mutual funds. The black color indicates mid cap mutual funds, and then the red color indicates small cap mutual funds. So the first three, which is like, the number 15.6, 22.3, 27.1, these are the mutual funds which have returned the highest returns over the last 5 years. And then you have mutual fund that has returned 15% in the large cap space, something that has returned 21%, and then 23%. So these first three dots that you're seeing are the best performance within the mutual fund plan space for large cap, mid cap, and small cap. And what you have here is the median returns of all mutual funds over the last 5 years. So for large cap stocks, you can see that the median returns is 12.8%. For mid cap stocks, the median returns over the last 5 years is 17.5%. And for small cap, it is 18.7%. So on an average, investors should expect that they will be able to make only about 13% by investing in large cap mutual funds, but approximately about 18% by investing in mid cap mutual funds, and about 18 or 19% by investing in small cap mutual funds. Investors always tend to look at this 27% or 22% or 15% and say, this is the fund that I will invest in, or this is the fund I will put my money into. And since they have returned 27% over the last 5 years, they will be able to repeat that performance. And there is absolutely no evidence to suggest that a performance which has historically done well will continue to, repeat that performance. In fact, all the evidence points to the contrary, that funds that have historically done very well, going forward also, they will not be able to repeat that exceptional performance. They also, just like how markets move in cycles, fund returns also tends to move in cycles, and that is what happens with mutual funds also. So the expectation, you might decide to go in with this fund which has returned 27% over the last 5 years, but from an anchoring perspective, from a return expectation perspective, please go in with the mind that you should be happy getting this median return of 18.7%. Anything more than that is good, and anything less than that, probably you should reconsider investing into a different fund. But the expectation should be anchored to this 18.7 or 17.5 or 12.8%. Very similarly, I pulled up the return expectations for PMS funds also. PMS are portfolio management services. Now, once again, the chart reads exactly like how it reads for mutual funds. The blue dots indicate, the first three blue dot indicates the highest performer within that category for large cap, black for mid cap, and red for small cap. And the ones here at the end indicates the median performance. So the median performance of large cap PMS funds has been 10.5%. For mid cap, it has been 12.3%, and for small cap, it is 15.5%. So the same story holds true. Even if you are investing in a PMS fund that has returned 21 and odd percent, the anchoring should always be around 12.3% if it is a mid cap fund, and 15.5% if it is a small cap fund, right? So that is how one should set our return expectations. That is what the realistic return expectations should be. Now we'll also take a look at return expectations for multi-asset small cases. Here I have plotted the return expectations for all-weather investing, equity and gold, and equity multi-cap. Now the black line represents equity multi-cap, and you can see that because it is a pure equity portfolio, that has definitely performed better than AWI or equity and gold, and it has returned 17.1% since Jan 2019. Whereas AWI, because it has a little bit of equity, a little bit of gold as well as bonds, has returned 11.9%, and just equity and gold has returned 14.8%. The orange line is equity and gold. Now, for a multi-asset small case, this 10.9 to 11% is the is what our return expectation should be. Now, one might ask the question as to why should I invest in something that gives me 10.9% versus something that gives me 17.1%. What is also important is to look at this volatility angle, right? Look at the amount of ups and downs in the black line. Compare that with the relatively lesser number of ups and downs as far as the green line and the orange line is concerned. So by investing in multi-asset small cases, what happens is the volatility that equity brings into the small case or to the portfolio, that gets negated by the relative stability of other asset classes like gold or bonds. So what it offers, what these multi-asset small case offers is relatively smooth wealth creation journey over the long term. And that is obviously, you can see that over here. So you sort of need to keep that in mind when it comes to multi-asset small cases. And accordingly, you have to anchor your return expectations. Next, we have I have plotted out the performance of factor small cases, and I have tried to compare that with equity small cap. Now, factor small cases are those which gives you access to one of the factors. Factors could be something like investing in small cap stocks is a factor, that is a size related factor. Then investing in momentum investing is another factor that gives you access to the momentum factor. Investing in companies that have low valuation is another kind of factor investing. It gives you access to value companies. Investing in companies which consistently pay dividends is another kind of factor investing, something like that, like Dividend Aristocrats offers you. So I have pulled out the performance since December 2020. Couple of things that I need to point out over here is, first, their relative performance versus Nifty 500. You can obviously see that, over the long term, most of these factors have outperformed Nifty 500 or the equity multi-cap that I have plotted over here, which is the black line. But at the same time, it is also important, and to note that when equity multi-cap or Nifty 500 was very flattish, right, which is approximately the time period between September 2021 till December 2022, or even afterwards, till let's say March 2023, you can see that alongside the flattishness of equity multi-cap, the factor small cases were also sort of flattish. Many of you, in fact, wrote to us during that time, pointing out that something like Cancel, Core Value and Momentum, which had historically performed very well, it has not been performing well. Why is that so, and stuff like that? And we have given clarifications around that in our newsletters as well. So people who have read that can obviously connect to what I'm saying. When the market performance is bad, no fund manager, no PMS manager, no small case will be able to absolutely beat the performance of equity, the stock market performance, and create exceptional amount of returns to investors. Investors really need to understand that when the market performance is flattish, most of your small cases or mutual funds or PMS funds also tend to stay flattish. And it is when the market start picking up, exposure to these kinds of specific factors like dividends or value and momentum or growth and momentum or small cap investing and all of those things, the alpha, the difference between the market performance and the performance of this particular factor small case, that sort of starts kicking in when the market tends to perform up. And that is obviously, you can see that in the performance over here, right? In March 2023, when the market started trending up, you can see the relative performance of this black line compared to what is happening to this, value and momentum small case or quality smart beta small case or even the Cancel small case, right? So that relative outperformance always comes in when the market starts moving up. When the markets are flattish, the factor small cases also tends to stay flattish and will not be in a position to sort of outperform the markets consistently. I hope that sort of clarifies. Now, this is as far as market movements and what are the leading indicators, understanding of asset classes, risk and return across different asset classes. What is the return expectations from a mutual funds or a PMS or a small case should be. What is our anchoring as far as return expectations are concerned? I've covered all of these. Now I'll quickly jump into the rebalance that we've done this time. I just have very little to present on the rebalance side. Now, first on the non-modern small cases side, we've not made too much of a change on the non-modern small cases side. Specialty chemicals, we completely skipped rebalance, and I think on the brand value side, we only ended up adding Vedant Fashions. So before that, I wanted to touch upon a couple of companies, both on brand value side as well as specialty chemical side, like Asian Paints, Titan, Pidilite, and PI Industries. Now, we repeatedly keep getting this question that, these companies have very high PE. If there is a market downturn, there is always a possibility that, these companies their price performance will be affected and they will drop and stuff like that. And in spite of that, why do you guys continue to hold these companies in your small cases, right? So what has happened with any one of these companies? I just want to quickly touch upon that. One, all of these companies have a very, very strong brand presence, and that is a huge moat as far as the performance of companies concerned. Now, what does it mean when somebody says it is like a strong brand presence? I'll give you an example. Pidilite, right? People might not know Pidilite, but everybody knows Fevicol, right? When it comes to industrial gums and glues and stuff like that, there is no other name that is available in the that anybody understands. Fevicol is sort of the by default name that has come up to that gums and glues segment, right? Which is what Pidilite has managed to create. Now, when it comes to paints, no other paint company has as much market presence or as much market depth in terms of dealerships and stuff like that when compared to Asian Paints. Very similarly, when it comes to jewelry and when it comes to watches and stuff like that, nobody has as much depth as well as breadth of presence when compared to Titan. So these companies over the long term have created these strong brands for themselves, and that acts as a moat for any other company to sort of come in and compete with them on equal footing. So that is the first reason why we like these companies. The second thing is what they have managed to do with this very strong moat is it has resulted in high quality. Now, quality is a term that is sort of bandied about. Everybody talks about. They say it is a high quality company. Now, what is the source for that? How do we calculate this high quality and stuff like that? We have within Windmill Capital, we have created these proprietary scores, quality scores and growth scores, where we use items like return on equity, variability of earnings, consistency of growth, and these factors and we create metrics to understand where on the quality scale these companies stand. So when it comes to companies like Asian Paints or PI Industries or Pidilite or Titan, they have consistently ranked higher on both the quality as well as the growth scale, which is extremely difficult to do, right? But these companies have managed to do that. They're whether it is quality or growth, they've always been in the top quartile, top 1 or 2 quartiles, right? And which is another factor. Now, and third factor is they also operate in fast growing industries, whether it is paints, whether it is Fevicol, whether it is jewelry and watches, or whether it is agrochemicals and life sciences segment. All of these have been fast growing because of various factors like demography, because of a lot of research funding going into science, because of a lot of foreign companies looking to India for their research, for boosting their research capabilities and stuff like that. These industries have been growing very, very fast over the last decade or so, and we think that this sort of this growth there is a lot of potential for this growth to sort of continue. And these 4 companies especially, they sort of click every single checkbox that you have to have. They have a very strong brand presence, very high quality, consistent growth, and they operate in fast growing industries, right? So, which is why, in spite of their high PE, we tend to hold on to them. We have consistently kept it in our small cases, and we hope to continue to be able to do so, right? That is as far as non-modern small cases are concerned. And there is one company that I would like to talk about that we've added in the brand value small case this time, which is Vedant Fashions. Now, Vedant Fashions, as some of you might know, operates the Manyavar brand, right? They have brands like Manyavar, Mohit, Formev, and stuff like that. And all of these brands sort of like, they are an occasion-driven business, and the occasion being wedding. One thing that we have noticed, or one thing that is a worldwide phenomenon, is when it comes to wedding or these kind of special occasions, customers tend to be very price agnostic. They don't want to cheap out during their wedding, right? They want to, regardless of whether the quality is on offer or not, they want to buy expensive clothes. They want to buy expensive items to wear during their wedding, right? I'm not suggesting that Manyavar is offering cheap items at a high price, but I'm telling you that the space that they're operating, which is wedding occasion driven business, everybody knows about, like, the big fat Indian wedding and how it happens during most time of the year, and on top of that, there is this price agnostic behavior that has been witnessed in India also during weddings. So that, I think, is a very, very strong space to be in. And they, on top of that, because it's a occasion driven business, they operate in the premium and the mid premium segment, which helps their which helps their margins also, because they have a lot of pricing power. And third factor is they have a franchisee-led expansion model. They don't have to set up shop in every Indian city, and spend money on real estate. They have a franchisee-led expansion model, and they have been expanding fairly fast. This is witnessed in their, fundamental performance also, both on the top line as well as the bottom line side. So due to all of these factors, and the fact that, all of these factors are actually translating into exceptional fundamental performance for this company, is what sort of convinced us that we should add it to the brand value small case. So just to, like I told you, that it is an occasion driven business and there is a price agnostic behavior. You can see that in the gross margin. As far as other companies, textile companies and stuff like that operating in in that space, the gross margin is just 27.3%, whereas for Vedant Fashions it was 74%. Very similarly, because they operate in the premium and mid premium segment, that also contributes to the margin, and you can see that with the EBITDA and net margin also. EBITDA margin, industry median, is 16.4%, net margin is 9.5%, and for Vedant Fashions it is 49.5% and 31.7%. And you can see that over the last couple of years it's been fairly stable. So it is not like 1 year they have turned exceptional performance or anything of that sort. So they've been it's been reasonably stable. And the third factor is this franchisee-led expansion model. Because it is franchisee-led expansion model, they are a very asset-light business. They don't have too much of a debt on their balance sheet, which is something that we like, because low debt translates into low interest expense, translates into high net profit, right? Which means high return on equity, high margins and stuff like that. And you can see that on the asset to equity side. So for the industry median number, it is about 2x. You have if you have 100 rupees of equity, you have 200 rupees of assets. And whereas for Vedant Fashions, you can see that it is very low comparatively, right? So this is the reason why we have liked this business and we've added it to the brand value small case. Next, we have model small cases. I'll quickly go through. So there has been a fair bit of churn in value and momentum small cases, close to 6 companies coming in and an equal number of companies going out. CanSlim also saw 4 companies being added and 4 companies being dropped out. Growth at fair price also the same number. I'm not going to go into each name here. The reason why we added, like we've historically talked about this in probably pretty much every single AMA, companies are added or dropped to model small cases simply based on numbers, right? There is no analyst discretion over here. If Titagar Wagons meets the criteria for value and momentum small case, we add it into the basket. And if DCB Bank or Indian Bank does not meet the criteria for value and momentum small case, we drop it from the basket, right? So we've seen reasonable amount of churn in value and momentum, in straight flush, in CanSlim and growth at fair price also. Dividend smart beta slightly on the lower side. So you must have all got notifications around the small cases that you've invested in. I'm not going to get into individual names over here, right? So that is as far as rebalancing is concerned. And I think that sort of brings us to the end of the presentation also. We've covered, just to sort of wrap up the entire discussion over here, we've covered, what are the leading indicators for the market. We've covered, how the performance has been. We've covered what are the internal factors that are driving the performance of the market. And like, we've discussed returns and risk, how returns and risk work across different asset classes. And then, we've talked about how different asset classes are graded or are stacked up on the return and risk scale. What should our anchoring be as far as return and risk is concerned from different, whether it is managed portfolios, whether it is mutual funds or PMS or anything of that sort. We've talked a little bit about our rebalances, what is sort of the rationale going behind our non-modern small cases also. We've discussed Vedant fashions and a little bit of discussion around modern small cases also. So that sort of brings us to the end of the presentation. You can start shooting in your questions and I'll be happy to take as many questions I can. So I think some of the questions that have come in today are, let me start at the top. So the first question is, Arpit Sharma, dividend stars I want to invest in, please suggest. So Arpit, you can look up the performance of the dividend star small case on the Windmill Capital website. There is no suggestion that we can give in because it is, Windmill Capital is a research analyst and we cannot offer recommendations or suggestions as far as small cases are concerned. It basically looks to invest in companies which have a consistent dividend payout policy, as well as whose dividend yield is on the lower side. I think 2% is the cutoff. Anything about 2% dividend yield, these are the companies that Dividend Star Small Case invests in. So I suggest you head over to the overview section on Windmill Capital's website and you take a look at it. There is a detailed blog that we have written out as far as the small case is concerned. You can check it out. And if you have any additional questions before you want to invest in, our support ID is support@windmill.capital. The email ID is available on our website also. So Arpit, go ahead and drop in a line. We will be happy to answer any queries that you have on that end. Next, Rajat Mandal, considering current market valuation, should we hold new small case investment? Which small case? If no, which small case should be ideal for new investment? Suggest, considering current market valuation, should we hold new small case? I'm assuming, Rajat, you are referring to whether we should be investing whether we should invest more in small cases. We have had a detailed discussion around where we think the market is heading, where the leading economic indicators are and stuff like that. I think if you look at inflation numbers, if you look at growth expectations for India as a whole, we are fairly bullish about the performance of not just the market, but the economy as a whole. So that should give you an idea of what we feel you should be doing as far as any investments are concerned and not just small cases. And like I told Arpit, we are a research analyst, so I can't give you any suggestions or recommendations around new investments or which small case to invest in. Sanjay Singh, hold or profit book. Sanjay, we've discussed if you paid attention during the AMA, you should be able to figure out where we feel what our suggestion is. Can you tell us about Angel One ARQ Prime? Saif Ansari. Saif, Angel One ARQ Prime is not a Windmill Capital small case, so I cannot give you any suggestions around that. Devani Rahim, I have 25 lakhs in my savings account and I want to put in all-weather investing small case. So what should be approach? SIP lump sum, because it will take 2 years, please advise. Well, if you have decided to invest in, let's say, all-weather investments, I would suggest instead of doing SIP, maybe you can go ahead and break it into 4 or 5 different parts and invest it every alternate month or something of that sort. But just take that as a suggestion or a way to approach investing in a small case, because it's a fairly high amount. Devani, I would suggest please reach out to your investment advisor on what is the best way to sort of deploy this money in all-weather investing. Eknath Patil, is it right time to invest in small case because market is lifetime high now? I've already discussed this in fairly good amount of detail. Wilfred, small growing companies, please quote. Once again, like I told you, we are a research analyst. You can take a look at our small cases. A lot of our small cases, there are small cases like quality smart beta, quality small cap smart beta that gives investors exposure to small cap companies. There are other small cases also that sort of like, because of the way the criterion has been set up, there is a lot of self-selection of small cap companies. So Wilfred, I would suggest you check out those small cases. Value and Momentum or Cancel List are some of the names that I can think of. Please don't treat this as a recommendation as far as investing in these small cases are concerned. I'm only suggesting small cases. Kindly do your research, talk to your investment advisor before you decide to jump into investing in any of these small cases. Arpit Sharma, I want regular passive income to future aspects. Please suggest. Once again, we are a research analyst. Arpit, we are not an investment advisor. So kindly look into reaching out to your investment advisor. Shivam Rai, looking to invest 5 lakh lump sum for 3 to 5 years in mostly small cap small cases. Which small case is best option? I've already answered Wilfred's question around small cap companies and small cap specific small cases. Shivam, I would suggest you check out the same. But once again, obviously, please reach out to an investment advisor before deciding to invest. Sudhir is asking how paid small case works. Why are you cunning towards paid small cases? I'm not too sure why we are cunning towards anything. Well, paid small case works in a way that you need to pay a subscription. We have 15 paid small cases. You can take a look at which small case you like, pay a subscription fees for those small cases, and then the weights and constituents are revealed, and you can go ahead and invest in that particular small case. And as far as why are you cunning towards small paid small case, I'm not too sure what you mean, Sudhir. If you have any further questions, like I told you, please drop in a mail to support@windmill.capital, and I'll be more than happy to answer that. Okay, Anuj Singh, as Nifty has reached all-time high, should we hold our investments or keep our investments even after economy drops? News in US markets, India seems to have no effect on it. We've covered all of this. Nagraj CS, during invested 3 lakh in 2021, it turns low, which is the best. Like, once again, Nagraj, I told you how the market has been sort of moving sideways since 2021, and it is only since March 2023 that we have started. The market has started trending up, and I've also gone into a fair amount of detail on why it has started trending up and why we think it is a long-term trend. So I hope that answers your question. Which small case is best for next 10 years? See, any small case that we build and put out, we do it from a long-term perspective. These are not trading instruments. We don't suggest investors invest in small case for 1 month, 2 months, 3 months, or intraday trading and these kinds of things. So all our small cases are good for the long-term investment perspective, are good from a long-term investment perspective. The question is whether or what small case is good fit for the investor. So Tejasvi, I suggest you take a look at our small cases, check to see what is the kind of small cases that you would like to invest in. Reach out to an investment advisor to discuss your investment options. If you have any questions as far as the small case is concerned, you can definitely reach out to us. Which SIP is good investment for long term? I've already, Shweta, I think it's sort of like I've told you the same thing. Whatever I've told Tejasvi also is applicable. Roshan, which is the best small case right now, 3 to 5 years? Once again, same answer. Will the free small case would be changed to fee based? Chaitanya Sundar is asking me this question. Chaitanya, we have no intentions of changing free small cases into fee based. By chance, if we do change or if we mark any one of our existing free small cases as fee based, for existing investors, it will continue to be free till you completely exit the small case. This is sort of the stand that we took when we moved to a subscription plan model. Also, investors who had already invested in Value, Momentum, or Cancel or any one of our paid small cases, we have continued to keep it free for investors who had invested in that small case before the subscription plan came into existence. And if something moves to fee based, if any one of our current free small cases moves to fee based, we will go ahead with that policy, right? I hope that clarifies. Sudhir Reddy, growth at fair price small case is not performing well. Could you please let us know when can it reach with others? Well, Sudhir, I think with improvement in performance, I think I showed you the chart also. The performance has started picking up. Obviously, all factor performances were underperforming or had had flattish performance over the last couple of years. But with obviously the market picking up, our factor small cases have also started performing well. If you have any specific questions around growth at fair price small case, kindly write into support@windmill.capital and we'll be more than happy to answer it. Why go for small case instead of mutual fund? I think a couple of different options is one, the variety that we offer, right, Ramesh, in terms of whether it is exposure to specific sectors, exposure to specific factors, the kind of model small cases that we have on offer, or the kind of themes that we have under non-model small cases, whether it is specialty chemicals, whether it is brand value, whether it is banking privately or rising rural demand. I don't think there is any mutual fund company I can say this with fair amount of confidence. I don't think there is any AMC in India today which offers this sort of breadth to you at the cost that we are making it available, right? A lot of these small cases are free to access. There is no expense ratio or anything associated with it, right? So that is a reason why anybody should be considering small cases versus mutual funds. What is the investment vision for straight case? I'm not sure what investment vision is, for any small cases. It is a models based small case. Any company that meets the straight flush model criteria is retained, and anything that does not is dropped from the basket. That's what it is. Anmol is asking, what's the criteria for changing the weight of ETFs in top 100 small cases? We are trying to, anytime we try to rebase the top 100 small case, we are always making sure that, we are trying to optimize for volatility, and we are always trying to keep the volatility on the lower side. So at what weight range the volatility is the lowest, that is the suggested weight for top 100 small case. Why loss-making stocks also being kept in some of the small cases like Voltas and House of Tata? Sagar is asking that. So in the idea behind any sectoral trackers like House of Tata or Auto Tracker or FMCG Tracker is to give exposure to a specific sector or business house and stuff like that, which is why sometimes if the company meets the model criteria, meets the sector criteria like Voltas does, in spite of its recent underperformance, because it is part of the House of Tata, we tend to keep it in the small case. Puneet said, what would be the minimum investment value in value and momentum? Well, minimum investment value is what is suggested on the small case side. That is the minimum investment amount that is anyhow there. Anything over and above that is completely up to the investor to invest in. Should we go SIP way or lump sum way? I would always suggest SIP way, because then you will be able to capture both the ups and the downs of the market, and you will end up with a good average investment amount. Aryan is saying, being new to investing, what according to you should be the factors one should look at while choosing a small case? Aryan, you can head over to windmill.capital. There is, or you can go to, you can check to see. First, you should be clear about what are the kind of small cases that you want to invest in, what are the kind of themes that you want to invest in. Once you're clear about that, take a look at what is the historical performance of the small case. You can read through the blog of the small case and try to understand what is our rationale or our reason why we have created a specific small case. Please also look at the volatility label of the small case, right? A lot of them are marked as high volatility or medium or low volatility. If you're a new investor, my suggestion is go in with low volatility small cases. Also go in with small cases which have a small amount of minimum investment amount, so that you're comfortable with the amount that you have invested. And as you gain experience in the market, you can move towards high volatility small cases which have higher minimum investment amount. Can you post a link to your website? It is windmill.capital.smallcase.com. That is where you can head out to check out anything, or you can also go to smallcase.com, and in the discover section you can look up Windmill Capital as a manager. So that should work. Nupur, I think that should bring us to the end. I have Apna Satyavan small case. Is it correct portfolio? Should I? It is Noorin. It is not a Windmill Capital small case, so I cannot offer any suggestions on that. Siddharth is saying, how SIP working specific small case, because each small case has a certain number of stocks and are SIP amount may not be able to accommodate all the stocks in the small case. So that this there is a algo or logic that we have used. It's fairly complicated. I think we will run out of time if I try to explain that. I suggest you drop in a line to support@windmill.capital, and we will share the working with you, or the broad outline of how it works with you. Sujit is saying, I have subscribed to small cases which are free. I see that there are stocks that overlap in free-based and fee-based small cases. Should we sell if they overlap? I suggest you, Sujit, you keep each small case or by itself. Look at it as a specific portfolio, and don't get into any buying or selling because there is an overlap, right? Rahul Mahatra is asking why a stock removed from one small case during rebalancing is added into another small case. What sort of analysis is done during such rebalancing? Rahul, I think we've touched upon this quite a few times. Each portfolio or each small case has to be regarded as a basket by itself. There are investment factors that go into value and momentum small case. There are specific criteria that stocks which let me put it this way: value and momentum and growth at fair price, because there is a value component to it. There might be some stocks which meet both these criteria, and they might be added because there is a momentum component also as far as value and momentum is concerned, and there is no such momentum component in growth at fair price. It might so happen that after a period of time the stock loses momentum, and we might drop it in value and momentum, but we continue to hold on to it in growth at fair price because it continues to meet the criteria. So you should not, Rahul, you should not treat it as a sell on one side and a buy on other side. Windmill Capital small cases are not. It's not like we are a brokerage where we are putting out a sell on one stock on that stock and continue to hold on to it in another basket. You should sort of look at it from a perspective of it meets the portfolio criteria in one end and it does not meet on the other portfolio, which is why we are dropping it. I think we've reached more than an hour's time now. We will stop our discussions over here. If you have any more questions, please sort of drop in a line to support@windmill.capital, and we will answer all your questions. Thank you so much for tuning in today. Bye.